All right, so let's blast off to explore GIFluence, the first study to directly relate dynamic visual representations, which are GIFs, to stock market outcomes. And I hope to show you that GIF sentiment derived from millions of stock tweets posts is a powerful incremental predictor of market returns, volatility, and fund flows. So what do we do in this paper? A lot of things. We construct a dynamic visual based market sentiment proxy from GIFs in postings on stock tweets. We examine how the GIF sentiment is related to market outcomes. So we first validate that the GIF sentiment is a good mood proxy. We then test whether GIF sentiment excites investor attention by examining its association with contemporaneous returns and subsequent returns in the next 4 weeks. And we also examine whether GIF sentiment is associated with, let's see, trading volume, high volatility, and whether there's a shift towards equity funds away from bond funds. And so there are many sentiment index in the literature already. Do we need another one? Well, yes, we think so, because of the new communication method that is getting popular currently. And so this is GIFs. What are GIFs? Well, they are graphics interchange format. They are videos that are looping short and usually display a sequence of images, and they're silent usually. And so GIF postings have been popular recently once they were allowed on stocktwits.com. And so Tumblr's CMO said that GIFs are now the vinyl of the internet generation. And so we see them more as a potential powerful psychological trigger. And so there's approximately about 10% GIF usage. That's pretty large, it's non-trivial, and it's done selectively and usually by people who are more prone to behavioral biases. Now, given that attention is scarce, visual salience can lose effectiveness if overused, but GIFs matter precisely because they are a significant enough proportion, but they're not ubiquitous. And compared to text communication, while text is low-cost, efficient way of communicating information, it's much less so for communicating system one thinking. So we think that the visual salience is much higher with GIFs than with text. And with visual salience, it's going to be triggering system one processing rather than the deliberate, slow processing under system two. And so with system one, the communication is more vivid. And so it elicits emotional responses more so than text. It's also more succinct, and the immediacy of the consumption amplifies the emotional intensity. And then there is also motion associated with the GIFs, and that can influence and shape investor beliefs because it can influence optimism, risk tolerance. And there's been a psychology research among other behavioral research on this. And so what is particular about GIFs relative to just visuals is the motion. And the motion induces a physiological arousal. And so with this arousal, you're going to get more extreme valuations, you're going to get more risk-taking, more impulsive decision-making that's driven by autonomic responses. And so these mechanisms suggest that GIF is very well suited to induce more impulsive investment decisions. And that we feel is a good source for trying to capture the effect of the investors when they use GIFs. And there's also narratives that the GIFs, the moving pictures, can actually depict. And with that storytelling, it's going to be able to encode expectations about what events are going to unfold rather than isolated states. So, for example, a rocket launch can really be emoting, basically communicating momentum and inevitability. And so they can induce the investors, for example, to take an action and actually go trade. And so the GIFs excel at conveying these mental models or narratives that can encapsulate a complex ideas about future price trajectories in just a single vivid animation. So we're excited about GIFs. And so to summarize, why GIFs? It's popular on social media. It's an emotionally expressive visual communication format, and the visual salience can activate system one thinking, and the motion induce arousals beyond just static images to arouse an actual action taken by the observer. And they convey narratives in simple mental models of market dynamics. And so we think with all of these characteristics that GIFs can capture expressed investor sentiment that's not reflected in existing sentiment measures. So hopefully I've convinced you of that. So let's move on to the data. And so we have 65 million messages on StockTwits data. And by the time we cull it down, we have unique GIFs, like about 450,000 or more of them. And so what we do is we take these posts and then we calibrate the sentiment of each unique GIF by looking at the self-declared bullish or bearish labels that users can attach to them on StockTwits. So at certain point in time, StockTwits allow these user declarations and then also allow the use of GIFs. And so we use the sentiment of these unique GIFs in observations, even when the user doesn't declare their sentiment. And so this allows us to classify GIF sentiment on a large scale. And so the way we do it is for each unique GIF, we can classify based on where they are self-declarations about whether they're bullish or bearish. And so we can calibrate the net sentiment of each unique GIF, and then we aggregate it in on a daily basis across the market using the appearance weighted average variance. And so we get an aggregated GIF sentiment measure per day. And so this is high frequency relative to most of the existing sentiment measures. Okay, and so this is what you do when you're trying to post a message on StockTwits. Here's the text. And then you can declare bullish or bearish button. And then you can add a GIF, and it's tied to Giphy.com. And you can do a GIF search, select the one you want, and then hit post. And so that's what happens. That's how you do it. And so getting to the first set of tests, we first want to validate whether it's a mood proxy. And so we look at other sentiment measures, and then we run essentially a horse race to see whether it is related to these so-called exogenous measures of mood. And so the other sentiment measures consider from the literature are the text-based sentiment using Logren-Ritter set of words. And then we looked at just the self-declarations of the sentiment in the GIF postings that don't contain the GIFs. And then the famous Baker-Wurgler sentiment, the Michigan Consumer Sentiment Index, and we also have the Ravenpack measure of the media sentiment. And so all of these are constructed at the daily level where it's available, but the Baker-Wurgler and the Michigan index, they're monthly. Okay, so first test, validating the mood. And so we find that give sentiment behaves exactly like a mood proxy should. So we look at cloudy days and we look at the COVID-related restriction stringency over time, and we look at months indicators for negative sentiment that past literature has shown certain months of the year sentiment tends to be more negative. And give sentiment, our give sentiment measure consistently gives the right signs with these exogenous mood proxies, whereas none of the other sentiment measures actually consistently deliver significant correlations or even with the signs in the right direction. And so we feel that given this, our give sentiment indeed does seem to be capturing a purer proxy for sentiment than these other measures. These other sentiment measures primarily, I think, have some contamination from the fundamentals, and I'll talk more about that. Okay, so moving, and so looking at the correlation with actual fundamentals, we use the percentage of positive earnings news, and we find that our give sentiment isn't correlated, whereas most of the other sentiment measures have some contamination with fundamentals. Okay, moving along. How am I doing for time? I'm doing okay for time, right? I'm on slide 15 and it's 15 minutes in. Perfect. Okay, so let's look at, and then to further validate that we have a good scoring of sentiment, we ran our give sentiment, our gives through GPT-4o. At some point in May, while we were doing this, OpenAI's GPT-4o vision language model could label sentiments, calibrate sentiments as well. So we took the top 1% of our gives. It's very costly to buy the tokens. And so we took the highest appearing gives and we ran it through GPT-4o. We prompt GPT-4o to assign a continuous sentiment score. And we find that GPT-4o's score is pretty well correlated with our score. And so this gives us a more confidence that our give sentiment measure that we calibrated ourselves is pretty good. Okay, so now to the first test on market outcomes. We know that from sentiment theory, if that measure captures sentiment, then it's going to lead to overpricing, and that means high contemporaneous positive relation and a subsequent low returns, and which is exactly what we get. So we regress returns on our give sentiment plus all the controls, and then later we also separately, we also ran our give sentiment along with all the other 5 sentiment measures in the literature. And so this is what we find when contemporaneous returns, they are positively correlated with give sentiment. And then in the next month, in the next 4 weeks or subsequent month, the returns are negative and significant. And so a 1 standard deviation in the give sentiment is associated with a 27.3 basis point increase in same day market returns, and the reversal is a strong 126.5 basis points just in the following month. And so these are strong stark results. Now, comparing the give sentiment or controlling for other sentiment measures, we find that our GIF sentiment measure is incrementally predictive. So it is correlated incrementally, contemporaneously, and then in the subsequent month, it also predicts the reversals in returns. So this is a strong result that we're excited about. And then for robustness, we do a whole bunch of things as usual in empirical research with big data. We excluded the initial 3 months of GIF adoption period. Actually, I don't need to read it in the interest of time. I invite you to read the paper if you're concerned about the econometrics and any suggestions for improvement. They are very welcome. And so moving on to whether the sentiment measure effects are symmetric, what we notice is that a lot of the past sentiment measures often focus on negative sentiment. And in part because negative sentiment drives a stronger affect. But social media tends to focus more on the positive sentiment because that's how you get more clicks, more likes, etc. And we find that so then we separate our GIF sentiment into positive sentiment versus negative GIF sentiment to see whether their predictability for returns vary between the two types, and they do. And so we certainly find that positive sentiment predicts strongly, it's associated contemporaneously with, it drives strong contemporaneous returns. And then subsequently, there is a reversal, whereas the negative sentiment drives a strong same sign contemporaneous returns. But what I'm showing you here is incremental to all the other sentiment measures. On the standalone, for the negative sentiment, the reversals tend to happen within the week. But when we put in all the other sentiment measures, negative sentiment doesn't predict the reversals. Only positive GIF sentiment does. And we think that that's because the other GIF sentiment that tends to be focused on negative sentiment, the negative GIF sentiment is not as strong an incremental predictor over and above the prior sentiment measures. Okay, so let's then one concern might be that we have a short window since stocktwits.com only allowed GIFs in the recent in 2020 or so. So we don't have a very long time series. So we thought that a way to look at to increase the number of observations might be to actually look at intraday effects. And so we broke the day into 30-minute intervals. And so we run the test again on that. And what we find is that the GIF sentiment does the same thing about raising contemporaneous returns. And then we start to see the reversals even within 2 days with the 30-minute intervals. And so this gives us more confidence, supports the robustness of our main results, and alleviates some of the concerns about sample size or estimation instability. Okay, now moving on to additional cross-sectional results. The predictability of the reversals will be higher if the stocks are riskier and more costly to arbitrage. And so we look at two instances of such differences. So we sort firms by size and also by uncertainty. And so small stocks are riskier, more heavily held by retail investors, costlier to arbitrage. The GIF sentiment effects should be stronger. And indeed, we do find that the effects are strongest in the smallest stock quintile. And then we also look at firms with high idiosyncratic or total return volatility. And so for these portfolios, again, our give sentiment effects are stronger. Okay, and so considering now sentiment, when we have extreme sentiment, either high or low, is going to create disagreement, and this is going to uh, uh, leave tracks in the data on the market volatility and trading volume. So we relate give sentiment, the absolute values of give sentiment, the absolute values of sentiment to market volatility over different time intervals. And indeed, our give sentiment is associated with volatility in the short term. A 1 standard deviation increase in give sentiment corresponds to a 0.089 increase in weekly volatility, and that's significant at 5% level, and it's about 17% of the weekly volatility standard deviation. So these are meaningful numbers. And now turning to give sentiment and trading volume, we know that the visual nature of gives will, because of the physiological arousal, would drive market activity, and it can do so in two distinct psychological channels, the aggregate mood extremity and the individual disagreement channels. And so for the extreme sentiment, whether high or low, you can think of the rocket launch or a bear claw, where the market's tumbling, can create sentiment shocks. And the sentiment shocks can create disagreement. And this shock will draw in noise traders who trade heavily against the more rational, sentiment resistant investors, leading to a surge in trading volume. And so when we regress log total volume on absolute sentiment, we do find that give sentiments levels are associated with a higher trading volume on the contemporaneous 30-minute intervals over the next day and over the second next day. And then for the second channel, just purely based on disagreement, even if the average market sentiment is neutral, there can still be internal conflict, and we measure this by the standard deviation of the give scores within 30-minute intervals. And so, according to belief heterogeneity theories, when investors interpret signals very differently, and so represented here by the mix of the high bullish and high bearish gives, they are going to trade to reconcile these conflicting expectations. And so we do find again that the give sentiment disagreement does indeed explain the trading volume in the same interval time t and over the next day and the second day. And so the key takeaway here is that gives aren't just reflecting a monolithic mood. They're capturing intensity and divergence of investor beliefs in a way that traditional text-based measures often miss. Okay, let's see. I'm checking the time here. Okay, I'm almost out of time. And so in the last test, we examine sentiment and fund flows. And so we see that there are real world allocation shifts. High sentiment would predict inflows into equity funds and outflows from bond funds in the subsequent week, reflecting a broad shift in retail optimism. So we think this is quite a powerful test of market sentiment. And we do find that give sentiment indeed is positively correlated with equity fund inflows and debt fund outflows. And so to summarize, we introduce give sentiment. It's a dynamic visual-based measure of aggregate market sentiment derived from social media communication. We find that it captures variations in mood and attention, and it reflects how investor feelings can spread across individuals rather than arising solely from responses to mass media. The give sentiment predicts aggregate market outcomes incremental to existing sentiment measures. And so our study contributes to the social finance literature that David is very much in the forefront pushing the literature. And we highlight that the role of visual media in social transmission of investor sentiment is important. We show evidence that GIF sentiment captures the effective dimension of investor communication more consistently than established sentiment proxies. And in an ongoing project, we are looking at the firm level sentiment to exploit the content of GIFs and their characteristics in relation to the cross-section of stock returns. And so this is the high-level summary of the takeaway from the paper. GIF sentiment induces a 27.3 basis point returns and a reversal of 126.5 basis points. And this test is derived from a huge number of unique GIFs on many million stock tweets, postings, and it does suggest that GIF sentiment captures system one thinking, that the visuals can trigger rapid emotional processing, and it can predict volatility, returns, equity fund flows. So the bottom line is GIF sentiment identifies retail euphoria that can create temporary mispricing and offers a predictive signal for returns, volatility, and capital flow. Thank you very much.